Welcome back. So this is the last last video for chapter 7. And here we're going to think about global capital mobility and think about the differences between a Flexit uh, exchange rate regime, a fixed exchange rate regime, and then at the end we'll think about a FlexNet exchange rate regime and why countries might choose that regime. I mean, it's not like they're saying, there's a menu of choices and they're like, oh, I'll take the FlexNet. That looks good. But they, end up there and there's reasons for that. Okay, so if we think about Flexit regimes in the long run, right? We said, okay, in the long run, when the economy is at equilibrium, when we're at our supply side equilibrium, then the exchange rate depreciation, delta, must be approximately equal to the differences in inflation rates, right? So domestic inflation minus foreign inflation. But we also said that the uncovered interest parity condition says that the expected depreciation rate must also be equal to the differences in interest rates. And so that must be the domestic interest rate minus the foreign interest rate. So you'll notice we have delta on both sides of this equation. So if we take our example, right, where we're looking at South Africa, and South Africa, now has a Flexit regime with an inflation target of 4.5%, then if we look at the difference between the U.S. and South Africa, then that's going to sort of determine the expected depreciation rate, right? Because if South Africa is successful with their inflation targeting, then they would have 4.5% inflation. The U.S. also is a Flexit regime, but has a lower inflation target of 2%. So if they're successful, then inflation in the U.S. would be 2%. But that means that the depreciation rate for between the rand and the dollar would be equal to the inflation target in South Africa minus the inflation target in the United States, which is 4.5% minus 2.5, minus 2%, so equals 2.5%. So that means that the depreciation then also must be, the expected depreciation must be 2.5% as well. And the difference between interest rates between the two countries and the difference between inflation rates between the two countries must also be 2.5%. So that means that, if the United States policy rate is 4%, then the South African policy rate must be 6.5%. But that kind of goes against what we were calling Flexit regimes, right? Because we're saying flexible exchange rate regimes with inflation targeting have monetary policy as opposed to, say, fixed exchange rate regimes. And so is South Africa actually able to choose its interest rate? And the answer is yes and no, right? So yes, they can choose their interest rate, but it could be constrained, especially over the long run, right? Over the long run, we have to get sort of this 2.5% difference, which is sort of set by the different inflation targets. In the short run, right, if South Africa gets, for instance, a negative demand shock, then they will be able to decrease their interest rates in the short run. But they do have to be careful because they have to make sure that they don't decrease it so much that the global capital, leaves the country and makes the demand shock worse. Now, fixed exchange rate regimes do not have monetary policy, right? Because in fixed exchange rate regimes, we're saying the depreciation of the nominal exchange rate is zero. And so we're saying it's going to be the same now, it's going to be the same in a year, it's going to be the same in 2 years, which means that our domestic interest rate has to be equal to the foreign interest rate, whichever the interest rate of whatever currency we pegged it to. And so that means that we can't set our interest rate different than the foreign interest rate. So in that case, right, then we know that the our long run inflation rate has to be equal to the inflation rate of the target foreign country if we have a fixed exchange rate. Otherwise, our real exchange rate will be changing. Now, sometimes I suppose you might want your real exchange rate to change if you have an unbalanced trade, or if you've experienced different shocks. But what it means is like you can't control your interest rate in order to try to stabilize shocks. And that's the problem with a fixed exchange rate. And so this table, you can just sort of pause this if you want and sort of look at it. Sort of looks at the different exchange rate regimes and monetary policy, right? And so Flexit exchange rate regimes have monetary policy. They do have to be aware of the effects on the exchange rate and depreciation. FlexNet economies, can also use monetary policy, but they have to be careful, right, that they don't end up with higher and higher inflation, which is something we'll look at in just a minute. Whereas a fixed exchange rate that's credible, that people believe is going to be fixed, will have to keep interest rates the same. The problem, of course, is that with a lot of fixed exchange rates, they sort of lose credibility. And so markets believe that they will not be able to keep their exchange rate the same, and that they will have to devalue their exchange rate. And in that case, the global investors will require a higher interest rate than the foreign interest rate. So then that kind of brings us to our FlexNet regime, right? So, we sort of talked about three different regimes, and we said, well, the FlexNet regime is dangerous because, it can lead to really bad inflation, potentially even hyperinflation. Why would anybody choose that? Why not just do a Flexit regime? And the answer is not, it's because they're not necessarily choosing the regime itself. What they're choosing is other things that lead to a FlexNet regime, and it's usually about government expenditure. And so if we think about government expenditure, we talked about this a bit in chapter 5 when we talked about fiscal policy. But governments often would like to spend more than they receive in tax revenue, right? Either because they don't have a good way of collecting taxes from their citizens, or because increasing taxes would be very unpopular, whereas usually increasing spending tends to be more popular. And so in the country like the United States, if we spend more than we receive in tax revenue, we borrow. We borrow by issuing bonds, right? Government treasury bills, treasury notes, treasury bonds. Borrowing can come with its own costs, right? We talked about those a little bit, but it doesn't necessarily lead to inflation because you're sort of putting money into the economy over here and taking money out of the economy over here. But that's not always an option for every country, right? So one issue is that if investors get nervous about whether or not a government is going to be able to repay their bonds, then they will require a higher interest rate, right? So if you are a global investor choosing between 4% in the United States versus another country that has a big debt and you're worried that they won't be able to pay it back, you're going to be like, okay, well, you're going to need to pay me, 8%, 10%, 12%, 15%. And you might need to pay me actually in dollars rather than in your own currency. And that means that interest rates for those countries will be higher and higher, which of course then just actually increases the risk that there will be a default. And so this can lead to what we call a sovereign debt crisis, where the debt is increasing and the exchange rate is depreciating, making the debt even harder to process. Interest payments are going up and up and up. And eventually these governments can't borrow in global financial markets, right? Either because they defaulted or just because they look so risky that nobody is willing to lend them money. And so then what do you do if you can't borrow, right? One thing is to do would be austerity, where you increase taxes and cut spending. That is politically unpopular, and could make the whole recession worse. And so often what countries have done in this situation is just issue money, right? Increase the money supply. And so, back in, that could mean either just printing a whole lot of money in order to pay your bills, or more likely, it could just mean increasing the amount of reserves in the system by buying government debt. So now the central bank is the one buying the government debt because nobody else will buy it. And so this is very dangerous, right? So what happens is now there's more and more money in the economy, but there's not actually more production. And so what happens when there's more money but the same amount of stuff is that prices go up. And now, in order to buy all the things that the government wanted to buy, they need to print even more money or increase the money supply even more. That just makes inflation go up even more. And we end up with increasing inflation and hyperinflation. And hyperinflation is sort of a death knell to an economy because it means that the value of money is decreasing so rapidly that people don't even want to accept money, right? So, they'll be changing prices throughout the day. And you'll end up with shortages, you'll end up with lack of production, and that becomes a big problem, right? So historically, this was often just done with the printing press, right? We're just going to print a lot of money. You might have seen pictures online from like Germany and Austria in the 20s, where they just increased the number of banknotes in the economy so they became so worthless that people were bringing wheelbarrows of cash to buy things. Kids were making kites out of Deutschmarks. I think they were called Deutschmarks back then. Whereas today, often what happens is the government says, okay, well, I can't sell my bonds anymore to international investors, but I can still sell it to the central bank. And so the central bank will buy them. They'll put reserves into commercial banks. The reserves will then get lent out, and that will increase the money supply and inflation. So, and then as we said, right, it spirals out of control. As the value of money declines, you have to print even more. Inflation gets higher and higher. Eventually, you end up with hyperinflation. Households don't, want to keep money because it's going to be worth less and less, so they spend it even faster. That pushes up inflation more. Wages don't get adjusted as fast as prices, and so that makes people's real income fall. And it's just a bad situation. So, people don't want to hold government bonds. They don't want to hold money. What do? Often you switch to a different currency like the dollar or the euro. But, if you don't do that officially, right, if people just switch to the dollar or euro, or sometimes these days people will start buying cryptocurrency, that will just make the nominal exchange rate depreciate more rapidly. That means that imports become more expensive and just increases inflation even more. All right, so here are sort of our key themes with looking at the three different kinds of exchange rate regimes. So whether or not they are flexible with inflationary targeting, whether or not they have monetary policy, independent monetary policy, give some examples, and the supply side equilibrium. So international economics can be pretty confusing, but it's important to think about, not only trade and immigration, but also the sort of global financial system that can, in some ways, be very beneficial because it can help fund development in poorer countries. But in some ways can be sort of destabilizing if global capital leaves a country very quickly. And it also helps explain how countries can get sort of stuck in a situation where it feels like the only way to actually pay their bills is to engage in monetary finance, and that leads to hyperinflation and very bad outcomes. So in chapter 8, we will look at systems, economic systems where there are multiple equilibria and where we may be pushed to a higher equilibrium or a lower equilibrium. We'll talk about tipping point equilibria. We'll look at housing model as well as environmental issues as examples of that multiple equilibria. And then we'll also look at sort of dealing with risk and uncertainty. And the difference really between risk and uncertainty is that with risk, we sort of know the probabilities, right? We know how likely each outcome is. Whereas with uncertainty, we don't. We might not even know what the possible outcomes are. And so that can cause some more problems.